Okay, it's time to go over options in the market. We'll be going over how to use them. We'll be going over how to use them the correct way to minimize losses and maximize gain in the market. Now, an option is the financial tool that allows you to own the right to buy or sell 100 shares of the stock at a fixed price before a specific date. Every option has a strike price, an expiration date, and a contract multiplier. We need to learn all these terms to understand option prices and what they represent. Now, a strike price is a specific price at which an option owner can buy or sell the asset and the option is tied to. If I own a call option with a strike price of $100, I have the right to buy the stock at $100 no matter what the stock does. This is your locked in strike price value. The expiration date is the final day an option exists and can be traded. An option's final value is determined on the expiration date. If I own a call with a strike price of $100 that expires in 30 days, I can only use the call to buy or sell shares at $100 for those 30 days. Now, the multiplier is a single share of stock with a price of $100 can be purchased with $100 in cash. Options are a bit different. If Apple's option is listed at $5, we need $500 to buy that one contract. The closer we are to this expiration date of the contract, the cheaper the option will be to buy, due to less time we're giving the stock to move up or down. We're not going to get into exercise and assignment too much, but exercising an option is when a holder of an option chooses to buy in cases of a call option or sell in cases of a put option, which we'll get into, 100 shares of stock at that strike price. It's like using a special coupon to buy or sell something at that price you're locked in earlier for. Option owners have the right to exercise their options. For every option owner, there's a short option trader who's on the other side of the trade or the market. When the option is exercised, a trader who is short that option is assigned the share of that stock at that option's strike price. Now, we're not going to get too much into exercise and assignment. I never exercise my options. That's just not the way I trade, especially as a day trader or even a partial swing trader. So now we're going to get into call options. In theory, this is like just buying a stock, thinking it's going to go up, or buying an indice or pressing buy on your futures contract. Call options is the option contract in theory of the price is going to go up, exactly like the stock would go up when you'd buy it. The value will dramatically increase as the stock moves up. This comes along with moving variables in options. That's why this is very hard to trade. It's like extra moving parts. We're going to get into the Greeks a little bit later. And then we're going to get into adjusting the in the money, at the money, or out of the money contracts. This, along with expiration dates, will give you different risks to rewards and can make a 30% gain into a possible 300 or 3,000% gain, and vice versa. If you were playing a little bit safer and you were taking a 20% loss, if you were to play a riskier option with a closer expiration date, that 30% loss might now be a 90% loss. That's why risk to reward is very big with options, and you need to know how to use them. If you don't know how to use them, they can go against you very, very quick, even if you're in theory right about the option contract or the way the price is moving. Put options is the same thing as selling or short in the market. We're expecting price to go down. We're then selling 100 shares of that stock at that strike price. As the price goes down, our options increase in value. As the stock moves up, we lose money, just as if we were shorting the market. Again, the multiplier is the expiration date and the Greeks. So we have intrinsic and extrinsic value. Right now we're going to go over intrinsic value. Call options have intrinsic value when the stock price is above the strike price that we're buying at. For example, if Apple is $100 per share and the options contract, the strike price is at $98, we have intrinsic value. For put options, we will have intrinsic value when the stock price is below the put strike price. So if Apple is at $100 per share and our option contract is at $101 strike price, we then have intrinsic value. It's in our favor. The higher the intrinsic value, the more money you will make as the stock goes in your favor. Extrinsic value is associated when the stock price is under the call price. For example, if Apple is at $100 and our call price is at $101. And for put options, Apple is at $100 and our put options is at $98. Intrinsic and extrinsic value have a big role to play, along with delta and theta, which we're going to get into. It is part of the Greeks. Mainly for intrinsic value, delta is going to rise and it's going to be your friend. You will then make a lot more money as the stock goes in your favor. And the opposite for extrinsic value. You're going to have more theta decay, which is time decay, we're going to go over. And your options are going to be worth a lot less. So like I said, the value is determined from the amount of time until expiration and the expected stock volatility. So if the stock is expected not to move in your favor due to lack of volatility in the market, or the stock just doesn't move that much, the extrinsic value is going to be greater Therefore, your contracts will be worth a lot less. For intrinsic value, if the option is at expiration, it is worth 0 unless there's intrinsic value in the stock, which means the stock is over or at your strike price. Extrinsic value under your stock price, your option contracts will be worth 0. So at the time of expiration, if you buy a call option at $100 for Apple and Apple's at $99 and we're at the expiration time, your contracts are worth absolutely 0. No matter if it's $1,000, $10,000, or $100. Also with intrinsic options, which is options in the money, they'll always cost more than extrinsic options. And we're going to get over in the money, at the money, and out of the money, which is ITM, ATM, and OTM. So like I said, there's 3 monies: in the money, which is an option that has intrinsic value; at the money, which is an option is at strike price or near stock price; and then out of the money, which is an option with no intrinsic value. And this consists of 100% extrinsic value. So for you to trade options, you would go here, you'd put in your ticker symbol. For example, we're looking at QQQ right now. You go to trade, all products. Most brokers are going to be laid out the same. Over here, I have volume. You want to make sure there's volume in your contracts. With QQQ, SPY, Tesla, any of those, there's always going to be good volume to get in and out. If you go for something a lot less, volatile, like Roku or something like that, you can see 9 days out. We still have some good contracts in here. But if you were in the money for 9 days out over here, your volume is only 1. So there's only 1 contract being sold, 20, 40, 23, and then down here you have 9. It's very hard to get in and out, and the spreads will be a lot greater on contracts like this. So you always want to make sure there's good volume coming through your contracts if you're not trading QQQ, SPY, Tesla, Apple, or anything like that. You will always have good liquidity. 26,000 contracts here, 5,000 contracts, 27, 1,400 in here. So you don't really have to worry about volume. Just take a note of that when you're trading something less volatile. We'll stick with Tesla right now. So we're going to touch into the Greeks right now, but I just want to make sure you can see the volume. Make sure you have good volume when you're trading contracts. This is at the money. Up here is in the money, and over here is out of the money. As you can see, the prices for them are a lot less because the chances of them moving to that strike price is a lot less. You'll then see how the multipliers of delta and theta work afterwards. I just want to show you the quick run around over here. We have calls on the left side and puts on the right side. As you can see, as strike price comes down, 152 over here, 167 over here, the option contracts cost a lot less. There's a lot less volume because the chances of it reaching at that point are a lot lower. Same thing with over here. If you're trying to buy a call option for 185, the chances of Tesla getting to 185 in 9 days are a lot less likely than Tesla getting to 167, which is right here in the money, or even 175, which is just out of the money. So we get to implied volatility, which is the IV of the contract. This is the expected magnitude of a stock's price to change in the future, as implied by the stock's option price. The higher a stock moves in range of percentage, the stock or the volatility, the higher the IV will be. The overall percent change of the stock will have an impact on the price IV. For example, if Tesla moves 20 points in a daily range when it only costs $100, that's a big volatility change to something that only costs $100 and moves on the average of 3 points a day. So the implied volatility will have a lot bigger effect on something like Tesla. An example again, if we go to SPY costs about $519 and only moves in theory just a couple points a day. Yet, for example, right now, NVIDIA is about $900 and moves anywhere from 30 to 40 points a day. That overall percentage change of the market is greatly increased by NVIDIA than SPY. So implied volatility would have a bigger change on NVIDIA, therefore giving you bigger gains. So now we're going to get into implied volatility a little more. This is on the day. For example, if you entered a strike price contract at in the money, out the money, it doesn't really matter, and your entry implied volatility is 20%. If the IV changes to 10%, which means volatility is going down, it's drying up, you're going to be negative 10% on that, and vice versa. If the volatility changes to a 30%, you're going to be plus 10% on the IV change. So in theory, your stock price can stay the same, yet if volatility goes up, your contracts will be worth more than if they were staying the same volatility or going down, and vice versa. If the stock stays in the same range, yet volatility goes down, our contracts will be worth less than if they stayed at the same volatility or more. The chances of price moving in total are less with less volatility and more with more volatility. Just as simple as the market works. There's been multiple times that I've bought a contract when there was little to no volatility, and volatility increased right away, and my option contracts almost doubled, just barely moving any strike price or at all, just from the volatility change. And this can happen vice versa. If you get in right away in the morning when volatility is high and then volatility dries up midday, your options will be worth less, even though your price is in the same range and your thesis still might be correct or it's in the same area. So now we're going to get into delta, which I just showed you before on my thinkorswim. It's the measurement of the sensitivity of the contract's price change and related to the asset's price change. If you have a delta of 0.5, every dollar the asset changes, your contracts will go up 50 cents. So if Apple's at $100 and your option contract delta is at 0.5 and Apple rises to $101, you will see a 50% increase in your option contract. So I'll give you an example here. On SPY, if we're sitting at 0.59 right here, as you can see, in the money contract, it's going to cost us about $4.93. Now, if SPY moves from where it's sitting at right now, which is 519.41, if it moves to 520.41, we're going to get a 59-cent gain on our contracts, moving us to about 540, 545. Now, this is a little over a 10% gain just in a $1 move over here. There's going to be other things that come into play. Just like I said, implied volatility, theta will come into play, expiration, and everything, but we will get into that. So for example, if your delta is 0.2, our options will mimic the profits and losses of approximately 20 shares of the stock. If an option has a delta of 1, which will be super deep in the money, that option will trade like 100 shares of stock. Delta basically tells us how much of the value of the particular option will fluctuate with the corresponding move of $1 to the stock price. It represents the odds of that particular option has of expiring in the money. So for example, this delta of 0.59 has a 0.59% chance of expiring in the money. Delta also tells us how many shares of a stock option would trade like in profits of losses to 100 shares. So 0.5 will trade similar to 50 shares of the underlying stock, like Tesla right here. Vega is the change of an option's price due to volatility. The more time until expiration, the larger value of Vega you have. Vega is very good for assessing risk. The farther out your expiration date, the greater the Vega will be. So like I said, for example here, if we were to come to 1 day, Vega over here is about 11 in here, and then 2, 4, 7. As we get out the money or farther in the money, all these usually change and go less. The biggest volatility or spike change of anything in the delta, gamma, theta, or vega will always increase in here. Besides delta, coming in the money will always be a 1-to-1 or a 0.7-to-1, 0.6-to-1. Delta increases as we get in the money. Everything else stays increased in the middle range and then seems to die down as we get farther in or out of the money. But for Vega, as we're looking at right here, we have 11, 11, 9, and then we go to 2 days out, we can see 15 in here, and then we come all the way out here, and we see 28, 29, and then the 9 days out is about 30. So the higher the Vega, the easier it is to assess your risk due to also the expiration date. And then we have the absolute killer of options. We have theta. Theta is basically just time decay. The closer we are to expiration on our options, the higher the theta and the more it matters. So now, like I said before, extrinsic value and theta. Theta is heavily increased when an option is out of the money or at the money. This, along with the close expiration dates, declines your option contracts drastically. This is why theta is the absolute option killer. If you buy something at 9:30 in the morning, for example, at $1 option contract, and we're sitting in the exact same spot by 1 p.m., your options might now be worth 50 cents, so you lost about 50% of your value even if the price of the stock has not moved. And then by 3:59 p.m., if we're still at the same spot, your options are worth almost zero, and then the next minute they'll be worth absolutely zero. So the true definition of theta is the rate of decline in the value of an option attributed to a 1-day change in its time expiration. So if everything remained the same, if implied volatility, stock price remained exactly the same on an out-of-the-money contracts, it will shed its intrinsic value as the expiration date or time comes near. So theta is just time decay at that alone. So for example, let's pull up one of these charts in here. So if you look at this chart in here, you can see that Tesla indeed didn't go up. This is a call option. It was worth up to 69 cents. At the beginning of the day, it was worth almost 12. So we had a huge move up. And then as it did not stay to its strike price, we then came down as the stock moved. And then since this was under the strike price, this was an out of the money option contract by the end of the day. It was worth absolutely zero at the end of the day. This is all theta decay. So this is the option contract to the left for QQQ over here to the right. As you can see, the stock went up and we went up with the call options. You could have bought it here at 12 cents and you could have made about, and you could have got $1.40 per contract. This is over 1,000% move right here. As the stock starts to come down, as you can see where this price in here was once $1.26, we hit the same line in here, yet now it's only worth $1.12. This is time decay happening. Again, over here, as the stock price was worth 81 cents right here, we come to the same part where the market was at, and now it's only worth about 60 cents. So if you look at over here at this timestamp at 10:06, the market in here was at 442. If we look at the market over here at 442 again, those contracts that were worth about 60 cents are now only worth 25 cents. So this is a 50% loss, and the market is in the same exact place just from time decay on the day. To give an even a better example over here, at 352, the market was at 442.25, which lines up with this bar in here. So in here, it was worth 79 cents. Now at the end of the day, at that point, the contract was worth 4 cents. This is time decay. As you can see, it starts to fall off, and then as the day goes on, it gets drastically worse and worse. Each of these peaks were almost at the same point. You can see every time we hit these peaks, we lost about 20% on the contract every single time just from time decay. So as the day goes on, it gets more aggressive and more aggressive. Now you might say, why even trade options or trade options at the end of the day? If you were to trade options at this fall right here or even in here, I'm going to show you how much money you would have made. So if you pick the right option contract anywhere in here, you would end up paying about 57 cents, 56 cents, thinking this move was going to happen in here. Or even if you got to here first, you would have ended up paying just about 28 cents. And then as this spike came down, you could have got about 25 cents. So you could have got almost 1,000% from this move here to down here. So when the market moves in your favor, especially late day or when there's good volume in the day, you can make absolutely insane money. Each of these candles are 1 minute candles. So you could have been in the market for 6 minutes and made almost 400 or 500% just in 6 minutes in here as the market came down. Obviously, like I said, this is a put option. You could have made an absolute killing taking the market like this. You're never going to find 400 or 500% or even 80% on any kind of contract you take besides option contracts. But like I said, if it's not in your favor, theta is an absolute killer. As you can see, just as the market rallied a little bit, these contracts went down 50% in no time. Just from this valley in here to here, so which is here to here, the contracts went down over 50%. So like I said, you have the Greeks in here, you have the delta, gamma, theta, and vega. You don't have to pay attention to all of these. If you're going to pick one, I 100% would pay attention to delta, but I prefer to pay attention to delta and theta. Like I said, out of the money, you're going to have a lot more time decay. And as the price moves up in your favor, you won't get that much of a multiplier on delta. So if this price of QQQ moves up $1, you're going to get 38 cents in here. Whether if you went in the money right here, you would get 60 cents. So you would get almost double your money going in the money in here. But then again, you would pay a lot more for your price. You pay a lot more for your strike price. The bid is at $1.08 over here, and the bid is at $2.86 in here. So if you're going for a long move, I'd recommend going 1 or 2 out of the money right here. And if you're going for just a quick scalp, I'd recommend going in the money in here, where you're getting a lot more money for your contracts, yet you're also spending more money. Now you might also ask, why am I not just buying in the money the whole time when this multiplier is great and this one isn't as good? Like I said, your prices are going to be way cheaper. If you're looking for QQQ to then end up at 447, if you're expecting a $5 move in the stock, you're going to be paying 80 cents for your option contracts. So once this ends up coming to in the money, as the price goes up of the stock, this will be then in the money or right in the money or right at the money. The delta will then rise accordingly. Like I said, 20 cents here. Once it moves up, it'll be around 25, 31, for example, like this. And you will then get a lot more money for your dollar. So if you're looking for a long move, I would go a little bit out the money, like 3. If you're looking for a short scalp, I would go at the money or in the money in here. Now for time of expiration, I don't trade long contracts. If you're looking for stock to move in one direction for a long time, for example, Tesla, Apple, anything like that, you can take contracts 9 days out, 30 days out, it doesn't matter. You're going to get a lot less for your money, and the contracts are going to be a lot more expensive. For example, if we're looking at 9 days out compared to 2 days out, an at the money contract is $2.31 at the moment. And if we're looking 9 days out, an at the money contract is almost $5, which will then be $500 per contract. So if you're expecting a long move over a couple of days, 100% I would go in here. For me, I scalp, so I go anywhere between 3 to same day expiration. Like I said, theta is increased drastically as the days are closer. So I would take theta into account. For example, we have 1.27 on the theta multiplier, and then we have only 83 in here. If we go to 9 days out, we only have 31 on the theta multiplier. Theta means a lot more as we get closer to expiration price. The chances of the price moving that drastically is obviously less in 1 day than it is in 9. That's why, as you can see in here, the theta multiplier is drastically higher in here than it is in here. Now these prices don't move that much over here as it's 1.8, so the theta isn't that large, but your delta also isn't that large. So if the price moves $1, you're going to get a 12 cents return on your price moving $1 in your favor. Whether, like I said, it is over here, if you get a $1 move in here, you're going to get 66 cents, which is a lot more. It's 6 times the amount almost. Again, this is call options, and these are puts on this side. We're going against the market, thinking the market's going to go down, and we're going with the market, thinking the market's going to go up. Your calls will always be on your left, and your puts will always be on your right. It says it up here. The same thing goes for volume. Make sure you have good volume on your contracts. Obviously, trading QQQ or SPY, the volume will always be there. So if you're just trying options out, don't go 0 days to expiration, which is this right here, 0 DTE. If you hear people talk about it, try to go at least 3 to 5 days out. Learn how to use your option contracts to then make you money. And then if you want to play more risky, knowing a move is going to happen, you can then go same day, 1 day, or 2 day out, which gives you a lot more reward than a 9 or 5 day option, yet the risks are a lot greater. If your contract expires out the money, like I said before, it will be worth absolutely 0. As you can see in here, all these expired out of the money and they're worth absolutely 0. Yet when you come just 1 in the money, these are worth 38 cents a contract, 70 cents, 21, $1.21, $2.28, etc. Same thing with over here. Now you can do contracts on futures, but they do cost a lot more money. As you can see, just 1 day out costs $11 and $12 on this side. I personally do not trade them. I trade SPY and QQQ and sometimes SPX. SPX has a 10 times multiplier. So if you see people making big gains, it's probably SPX. So you have to be very, very careful with SPX contracts. They can go in your favor, yes, but they can burn you as much as they go in your favor. I'm going to show you a quick contract in here on SPX. So for example, this move here on SPX, you could have easily bought it at $5.05 and you could have made all the way to $16 right here. As it slowly went up, you could have made $20, which is a 400% return. And we can look at other contracts, for example, like some out of the money contracts. So for example, just in 6 minutes on this move, you could have made about 600% on SPX. When you find big volatility and big moves like this with big volume, that's when you can see your contract multiplier goes up drastically and you can make 500-600% in just a couple minutes. Just the same thing with this small dip in here. Your contracts, if you bought them at the top at $5.80, would then only be worth $3. You would have lost almost 50% in a simple 3-minute pullback. The higher the risk, the higher the reward, and vice versa. Your rewards can be great, but then your risk can also be drastic. And again, for this, that was once worth almost $6. Since the price came back down to that original point where you paid $1 for it, at the end of the day, it was worth absolutely zero. In here, it was worth 5 cents. If you go to the same point on that big move up, you would have had $3.30 a contract. This is all time decay in here. You can see it drastically falls off. This peak, which almost touched the tops of those peaks in there, where it was $5.30, on the buying was $4.50, and as the day goes on, it drastically falls. This peak right here, where it was sitting at 5.226, you're looking at $2.50 a contract. Yet when the stock market was sitting up here, when we're at $5.08, your contracts would have been worth about 60 cents to about 20 cents. They were worth about $4 to $5 in here. This is all time decay. Perfect example of time decay. I just want everyone to understand what time decay is. It is the absolute killer. It's the make or break. Your theory could have been correct, but if time was not in your favor and theta decayed all the way, something that you bought at $1 or $3 will be worthless at the end of the day. So make sure you pick your expirations right. You understand how to trade it with volume. If you're looking for a quick scalp, you know volume's coming in. You can take contracts that are closer to expiration. And if you're looking for an all-day move, a multi-day move, I would take contracts 8 days out, 7 days out, somewhere in here. As you get better and understand everything more live in the market, you can then lower your time frames down, 6 days, 5, 2, and then if you want to, trade 0 DTE. Some of the best traders do not trade 0 DTE because they do not like it, which is perfectly fine. They're playing very safe. It's all about risk to reward, how much money you want to risk, how much money you want to get back from the market. So that is it for this options course. The next one will be how I set up my options on Thinkorswim and how I personally execute them.